Good day, everyone. Today, we will explore a critical aspect of transfer pricing known as advanced pricing agreements. With the ever growing complexity of global business transactions and the increasing scrutiny of multinational enterprise by tax authorities, advanced pricing agreements have become an essential tool for managing transfer pricing risk and ensuring compliance with relevant tax laws. An advanced pricing agreement is a proactive, collaborative approach between taxpayers and tax authorities to agree in advance on the transfer pricing methodology for a given set of intercompany transactions, ensuring that they comply with the arm's length principle. This arrangement offers certainty to taxpayers while mitigating the risk of disputes and audits, particularly in cross-border transactions. So, Module 7, Advanced Pricing Agreements. Now, let's start with definition of Advanced Pricing Agreement. An Advanced Pricing Agreement, APA, is a formal arrangement between a taxpayer and one or more tax authorities that determines in advance the appropriate transfer pricing methodology for related party transactions over a specific period of time. Now, the OECD transfer pricing guidelines defines advanced pricing agreements as agreements that establish the transfer pricing methods, comparables, adjustments, and critical assumptions necessary to determine the arm's length price of controlled transactions. So let us look at the purpose of it now, having explained the definition. Now, purpose, certainty. Advanced pricing agreements provide taxpayers with certainty about their transfer pricing arrangements, reducing the risk of disputes with tax authorities. Now, let's look at risk mitigation as well. By agreeing on the transfer pricing methodology in advance, taxpayers can mitigate risk of double taxation and costly transfer pricing audits. Yes, so as you agree on the transfer pricing methodology in advance, taxpayers can mitigate the risk of double taxation. Efficiency. Advanced pricing agreements streamline tax administration by addressing potential transfer pricing issues proactively, leading to fewer disputes and audits. So basically, you can see the definition and purpose of transfer pricing agreements. So let's look at the types of advanced pricing agreement. We have the unilateral, bilateral, and multilateral. For unilateral, this is an agreement between a taxpayer and a single tax authority. Now, this kind of agreement or this kind of unilateral agreement is between, let's say, for example, ABC Manufacturing Limited and FIRS. So, it is a unilateral agreement between ABC Nigeria Limited and FIRS. And the advantage, we'll look at the advantage and disadvantage of unilateral agreement. The advantage of it is that it provides certainty within the jurisdiction of the tax authority involved, while the disadvantage is that it does not address the risk of double taxation because it only covers one jurisdiction. In the example we use, ABC Nigeria Limited and FRS, it only covers one jurisdiction, which is Nigeria. So now let's move on to the next one. Bilateral advanced pricing agreement. The bilateral advanced pricing agreement is an agreement involving the taxpayer, one tax authority, and the tax authority of the related parties' jurisdiction. So the bilateral one is talking about an agreement involving the taxpayer, one tax authority, and the tax authority of the related party jurisdiction. So you can see there are two tax authorities here that are involved. One is the taxpayer, one is the tax authority, and the other is the tax authority of the related party jurisdiction. The advantage of this is that it offers greater certainty and reduces the risk of double taxation as it involves both jurisdictions. That means it involves the jurisdiction of um, of the party or of the company that is involved and the subsidiary and the subsidiary. So let's look at with the okay. Let's look at the advantages. The advantage is that it offers greater certainty and reduce the risk of double taxation as it involves both jurisdiction. The disadvantage is that it requires mutual cooperation between the tax authorities involved, which can be really time consuming. You can imagine having a transfer pricing or an advance pricing agreement between maybe HMRC UK and FRS. It is going to be time consuming and also resource consuming as well. So for multilateral agreements, an agreement involving the taxpayer and three or more tax authorities. So the advantage of this is that it provides the highest level of certainty by covering multiple jurisdictions and significantly reduces the risk of double taxation. The disadvantage is that more complex and more time consuming due to the need for coordination among multiple tax authorities. I don't even want to imagine this coordinating between um, maybe FRS, HMRC, and probably the Ghana Revenue Authority because of the multiple um, advanced pricing agreement. Now, having look at the unilateral, bilateral, and multilateral um, agreements, let's look at the advanced pricing agreement process in Nigeria. One, pre-filing consultation. The starting point is that the taxpayer initiates. So the taxpayer initiates the advanced pricing agreement process by requesting a pre-filing meeting with the Federal Inland Revenue Service. And after that, the pre-filing consultation is intended to discuss the feasibility, scope, and terms of the potential advanced pricing agreement, as well as any relevant issues that need to be addressed. So after the initiation, that is the pre-filing um, consultation, the next thing is the submission. The next thing is the submission. That is, there should be a formal application now. So after a successful pre-filing consultation, the taxpayer submits a formal advanced pricing agreement application. And the application must include detailed information about the taxpayer, the related parties, the controlled transactions, and the purpose and the proposed transfer pricing methodologies. So in this particular, for the content of the application, you must provide the detailed information of the taxpayer, the related parties, the control transactions, and the proposed transfer pricing methodologies that the taxpayer is using. And after that, we move to the review and negotiation. So Federal Inland Revenue Service reviews the application and may request additional information to clarify the taxpayer's position. And after that is done, after the review, we now move to negotiation. Well, let me use the word engagement here rather than negotiation. So FRS and the taxpayer engage in discussion to reach an agreement on the transfer pricing methodology and the assumptions underlying the advanced pricing agreement. Now, after the engagement with FRS, after it has been reviewed and they've engaged them, with respect to the transfer pricing methodology and the assumptions underlying the advanced pricing agreement, the next stage is agreement and execution. So once an agreement is reached, the advanced pricing agreement is formalized and signed by both the taxpayer and the tax authority, and the agreement specifies the transfer pricing methodology, the duration, usually 3 to 5 years, and the condition for its application. So the condition for its application would also be formalized. Now, adherence to that after the formalization. Now we look at the compliance and monitoring, compliance and monitoring. So during the term of the advanced pricing agreement, the taxpayer must adhere to the agreed transfer pricing methodology, and the taxpayer is also required to provide regular documentation and reporting to demonstrate compliance and to demonstrate that they are keeping to the terms of the advanced pricing agreement. Now, on the Federal Inland Revenue Service part, they monitor the taxpayers' adherence to the advanced pricing agreement terms, and they also conduct um, periodic review to ensure that they keep to terms. Um, Now we'll look at the benefits and challenges. For benefits, certainty and predictability. For the advanced pricing agreement, it offers clarity and certainty on transfer pricing methodology, reducing future disputes with tax authority. With respect to risk mitigation, they minimize the risk of double taxation and penalties associated with transfer pricing disputes. It also reduced compliance costs because advanced pricing agreements streamline compliance efforts by addressing potential transfer pricing issues in advance, reducing the need for exhaustive documentation and audit. So it also enhances relationship with the tax authorities because the advanced pricing agreement process foster a cooperative relationship between the taxpayer and tax authorities, thereby enhancing transparency and mutual trust between all parties that are involved, whether unilateral, bilateral, or multilateral. So the challenges here is that we have complexity and time. The process of negotiating or engaging for advanced pricing agreements can be very complex and time consuming. In fact, often requiring significant resources from both the taxpayer and tax authority. Then looking at the cost, preparing and engaging on advanced pricing agreement can incur substantial cost, especially for multinational enterprises with complex operations. Well, with also the third one, with respect to ongoing compliance, the taxpayer must ensure that they continuously comply with the agreed terms and provide regular reporting, which adds to the compliance, burden. So we'll look at some case study now. We'll look at some case studies. Case study one, which focus on unilateral uh, advanced pricing agreement in Nigeria. So let's look at the overview. XYZ Limited, a Nigerian manufacturing company, seeks a unilateral advanced pricing agreement with FIRS to determine the transfer pricing methodology for its intercompany transactions with a subsidiary in Ghana. Now, the process that will be include that it will be involved is that XYZ Limited will first of all initiate a pre-filing consultation with FIRS and then submit a formal application that includes the detail of the intercompany transaction and proposed transfer pricing methodology. After that, FIRS will review the application and then they engage each other on the terms with XYZ Limited. So the outcome, once an advanced pricing agreement is signed for a period of 5 years, providing XYZ Limited with certainty regarding its transfer pricing and compliance obligation within Nigeria. Now let's look at unilateral. That's unilateral. Now let's look at bilateral advanced pricing agreement between. Let's look at advanced pricing agreement with respect to bilateral advanced pricing agreement between Nigeria and the UK. So overview, for example, let's look at ABC Corporation, a Nigerian-based multinational, enters into a bilateral advanced pricing agreement involving Federal Inland Revenue Service and the UK Tax Authority that is the HMRC, HM Revenue and Customs, to cover its intercompany transaction with its UK subsidiary. Now, the process is that just like we have mentioned in the unilateral own, ABC Corporation also initiates the pre-filing consultation. Now, not just with one authority now, they initiate pre-filing consultation with both Federal Inland Revenue Service and HMRC in UK, and then they submit a formal application to them. Federal Inland Revenue Service and HMRC UK independently review the application, and then they engage in joint negotiation. Now, the outcome is if it is positive, the bilateral advance pricing agreement is finalized for a year for a 5-year period, ensuring that the transfer pricing methodology is aligned between Nigeria and the UK. So the transfer pricing methodology must be aligned between Nigeria and the UK, minimizing the risk of double taxation. Now, with respect to that's a case study that we view using the ABC Corporation. Now, let's move to the third one, which is multilateral advanced pricing agreement, which involve Nigeria, US, and Germany. So for example, the overview here is that GEF Incorporated, a multinational enterprise with operation in Nigeria, the US, and Germany, seeks a multilateral advanced pricing agreement to cover its intercompany transactions across all these three jurisdictions. Now, the process is still the same. Initiate pre-filing consultation with the tax authorities in all the three tax jurisdictions, that is US, Nigeria, and Germany. Then once when that pre-filing consultation is initiated, it submits a comprehensive advanced pricing application, which is then reviewed and agreed or negotiated by the tax authorities involved. Now, the outcome, if it is approved, a multilateral advanced pricing agreement is concluded for a 5-year period, ensuring consistency in the transfer pricing methodology across the three jurisdictions and reducing the risk of double taxation. So that is the outcome with respect to that. Now, in conclusion, advanced pricing agreement offers significant advantages for multinational enterprises by providing certainty and mitigating risk associated with transfer pricing. So, by engaging in an advanced pricing agreement, companies can proactively address transfer pricing concerns. They can also minimize the risk of audits and disputes, and foster a cooperative relationship with tax authorities. Even though the process can be complex, time-consuming, and resource-intensive, so therefore, businesses must carefully evaluate whether an advanced pricing agreement is the best solution for their specific circumstances. With Nigeria's Federal Inland Revenue Service, increasingly focused on transfer pricing compliance, advanced pricing agreement offers a valuable tool for ensuring that companies meet their obligation while avoiding costly disputes with the relevant tax authority. So, as the advanced pricing agreement frameworks continue to evolve globally, it is anticipated that more Nigerian companies will take advantage of this agreement to secure favorable and predictable tax outcomes. Thank you for your attention.